All right, Jeff, why don't you start us off with FOMC? What's happening there?
Yeah, for sure. So 2022 so far is not like 2021. So you see a bunch of different economic regime that took place in 2022, and we have been 1 month into 2022.
Yeah, feels like a lifetime.
Quite a lot
yes.
Yeah, exactly. So quite a lot of redness in the portfolio, everyone. Yeah. So on Tuesday, we see traders basically positioning themselves for a kinder FOMC meeting. So expect Powell to be a little bit less aggressive on this whole quantitative tightening process. But unfortunately, no more Mr. Nice Guy Powell. You start seeing him putting on the prospects that, hey, there's going to be more rate hikes to come in response of the rising inflation pressure as well. So that's pretty much what happened last week on the FOMC meeting.
Okay. So, I mean, we keep talking about macro, and I guess we only talk if something changes, right? Because if it was the same as last week or same as 2 weeks later, then there's no update. So I think that the change here is he sounded a bit more hawkish, I guess, and hawkish meaning that he wants to raise interest rates faster or he wants to tighten faster, rather than dovish, which means that he wants to loosen and ease up and boost economic growth. That seems to be the gist of it, right?
Yep. So I guess one of the things that really changed is for the US financial conditions has basically begun to tighten. So that's a good thing for the US. So you see the US GDP grew 6.9% pace to close out 2021, the strongest years in decades. And also you start seeing that the price action in January is largely a belated recognition of that hawkish shock. And it's a long time coming, really. Yeah.
Cool. Sorry, Rakesh, go ahead.
No. Please, Anthony, go for it.
Yeah, I was just going to say that, last time we also talked a bit about, the Fed having some tensions, they need to boost economic growth, they need to have full employment, they need to control inflation, and I guess the GDP figures also help with that, right? Because, GDP growth is great, employment, there's a great resignation, but otherwise it's decent, so they can really focus on inflation and trying to bring that down now without worrying too much about the other aspects. Whereas I guess 2 or 3 weeks back there was still some worry about the other aspects, so they might have been a bit more circumspect.
Yeah, so I guess on the back of what you have mentioned is that the Fed is really data driven, right? So one of the things that they have seen is that the economy basically proved to be resilient enough to that tightening to come. And basically this will actually keep the COVID recovery going as well. So that's something that the Fed is less worried about given the recent figures from the economic indicators. And which is why Powell is also saying that, hey, on the back of it, we see that there's potentially more rate hikes coming, more than 4. Right. So if you think about it, usually every quarter, if you do a rate hike every quarter, which is what's the usual practice for the Fed or any central banks per se, we haven't really seen one in the recent years where the Fed does more than 5 in that sense, where it's going to be a consecutive one. Maybe within the quarter you see 2 rate hikes. Yeah, so that's going to be interesting to see how it impacts some of these risky assets as well.
Got it. And I remember, Anthony, right? I don't know if this made it to the episodes, but we did some scenario stuff as we were preparing for one of these episodes. And this was one of it, wasn't it? Take us through it.
Yeah. I think, this was late last year, I would say. We were thinking, could it be 2 consecutive rate hikes, more than 4 a year, or even just 50 basis points, right? One time shock at all, and we kind of shock the markets into submission and shock inflation to submission. And at that time we were like, oh nah, this is impossible. Come on guys, the Fed needs to be predictable. The Fed needs to do things properly and be slow and consistent and be able to evaluate. And I guess things have changed. Over a month, right? Because right now the extreme hawks are going to say, we might have 7 hikes, which is essentially 1 every meeting, a quarter point move every meeting. And I think that question was put to Powell in his interview, and he daichied the question away. So he didn't say no, right? I think the scary part of it is he didn't say no. He just said, that's impossible. You guys go away. He said, we will look at the data we'll analyze, we'll make a decision. Just like COVID and our MMTF response.
Well, I mean, you got to cut Powell some slack as well, right? So right after the sharp sell-off in equities, then we start seeing that, perhaps you can find our footing particularly in more of the cyclical areas in the markets, as well as the pace of this hawkish innovation slows, and also the Omicron's impact on activity fades as well. So I basically expect that the Fed will revisit this dynamic of this whole rate hikes through the course of 2022 and see, what's the best outcome. So tentatively, markets pricing about 6 to 7 rate hikes. The Fed is looking at like 5 rate hikes. And I think it's a whole new economic regime that we are all looking at. They are not sure what's the best macro playbook to utilize right now as well. So got to cut the man some slack. And and
I guess still a small question mark whether this inflation is even demand driven, right? Because if it's supply driven or if it's partially supply driven, then there's not that much that the Fed can do. And with midterms coming up, not much that fiscal policy can do as well, given midterms and how precarious the Democrats' hold on power is.
Yeah, maybe we can despite on all this ongoing Fed risk, but we also can consider some things that we can basically risk a little in the EM complex. So if you look at say China easing, that provides some cushion that is hard to find in the developed markets as well. That's something that we can look at. Personally, I feel that I'm bullish China, because I think that there's better vibe apart from Omicron that basically have impacted them in the past, say 1 or 2 months, given that the whole COVID responses that they have been doing pretty much very extreme as well. But there's more upbeat messaging in the Chinese asset markets, with Chinese equities and bonds having to outperform their global counterparts year to date as well. So that's something interesting to look out for.
Wow, cool.
Can you tell us more about China? I think last time we spoke a bit about lowering interest rates, right? I think on the back of this whole lowering interest rates, we also need to look on the political front, right? So if you look at it from a political play, you see that policymakers are basically becoming more supportive of economic activities in statements and actions across regulatory and macro spectrums as well. So any of the negativity around some of these Chinese assets in the credit space or equity space, whatever, right? This associated valuation buffers basically means that there's even some basic form of policy clarity and a reconfirmation that policymakers are not insensitive to lower growth can eventually translate to better asset performance. That's how I see it. And also, if you look at it, the impact of Omicron should basically be very limited with the Chinese extreme COVID measures, right? And particularly since Winter Olympics is a thing that's upcoming, they are a little bit more cautious as well. So I would see that it's just another Fed that will eventually pass. Yeah.
Cool. Got it. So if I can sort of just sum up, right? So the Fed, a little uncertain. We're waiting to see what's going to happen on the first rate hike, which kind of explains that mountain, Anthony, that we talked about on Thursday night and then Thursday and Friday morning, right? Whatever you want to call it. But obviously we have to wait to see. So for our listeners out there, if you do have the stocks out there, what I might suggest is hold it. Let's wait for the first rate hike. And as per previous episodes, we do expect that to increase. Now, then the other part here is China, right? Now, China is almost the opposite of the US, where they wanted more inflation. They wanted more people to drive. They wanted more spending, which is why they cut rates. And this was in our, I think, 2 weeks ago episode. So if you haven't listened, Coconuts, please go ahead and listen to that. And now, Jeff, the added point here that you're mentioning as well is that they have sort of the political aspect of things has been laxed a little bit. So they do see that growth in the form of innovation and the companies can sort of do what they want to really get that going. Is that right?
Yeah. So for sure, I think in the space of China, there's quite a bit of things that has been boosting the economy, right? So the last time we discussed was trying to keep the financial market liquidity flush, such that it will be smooth sailing through Chinese New Year as well, and through all these, Chinese credit, potential Chinese credit defaults and what's not. But right now, they are also looking at trying to, see what they can do to raise economic activities in the form of innovation, tech innovation, and what's not as well.
Got it.
So I guess it's a bit of the opposite of the US again, right? Where the US has decently good economic growth, decently good employment, but bad inflation. So their policy is geared towards fighting inflation. Whereas in China, I guess that the inflation isn't that bad because everybody's locked up, cannot spend. But on the other hand, economic growth is slowing and that things aren't looking that great. So their monetary policy, on the flip side, is looking at boosting economic growth. So, and that's where I guess the divergence is.
That's right.
Absolutely. And I think one last question I have, right? We see a lot of news here with China, zero COVID and this and that. And how do you think that will impact, right? Because, for example, if they go into another lockdown because they've got like a couple of cases of COVID, do you see that really playing out 2022? Or do you think China, because of the GDP and because they want that to grow and consumption to increase and consumer spending to increase, they're going to abandon that zero COVID sort of thing?
Nah, man, they are not moving from zero COVID.
Yeah?
Yeah.
No way.
I'm with Anthony on that. I don't expect any major shift in China's zero COVID policy in the near term. So you look at case in point, right? You look at Winter Olympics. They still went ahead with it, but still kept they basically built a bubble around Winter Olympics, right?
Yep.
But still kept this whole China zero COVID policy that they have, and it's interesting to the rest of the world, right? Because they want to have people coming into their country to partake in such events, international events, but at the same time trying to keep a zero COVID policy.
Yeah.
I think ultimately they want to tell the world that, hey, if we can control COVID within our own country, and potentially this will, boost their own domestic economy as well in some sense, where all the spending, consumption will be consolidated in their own realm, in their own country itself. Yeah.
Yeah, I think I agree, and I think China just moves in a completely different scale, right? So we talk about travel bubbles, and we can't even keep like Changi Airport safe. They can create a bubble across an entire city. I remember I was talking to one of my colleagues late last year, right? Still during COVID, and they're like, oh yeah, we found a COVID case in a housing estate, the entire estate, which was like 50,000 people was locked down, and it tested everyone in a day. And everybody got cleared in like a day or two, and within 48 hours, people were back to normal. And I mean, that's shorter than our quarantine period if we do a positive ART test and we stay at home. So it's insane. They have the skill and all that which they can move and control, right? That it's just completely different. So maybe zero COVID can work, or they can try for it. And they have a big local economy, right? So even if they don't really open borders, they can kind of still survive internally.
Cool.
Very nice.
Awesome, folks. And lastly, Jeff, I think take us through the crypto markets, right? We've seen quite a bit of a fall. This one is not a mountain, it's a cliff. From November.
Just zoom out, bro. Just zoom out. You'll be fine.
Yeah, take us through.
All right, sure. So, crypto at ground zero of macro rotations. Interesting season for all of us, this crypto winter, right? So since early November, we see the total cryptocurrency market capitalization has fallen from by roughly 40% from a peak of 3 trillion to 1.7 trillion. And of course, we all know, for those that invested in the crypto markets, large drawdowns have been a commonplace in this volatile asset class, right? No surprise of that. But I think one thing to think about is how this latest episode of the cliffhanger was unique, and it appeared largely driven by macro catalysts. So no longer the same as what we talk about, where we have the developments within the crypto space, like all your layer 1, layer 2, layer 0 going on a war or what's not. No longer anything of that. So
no more curve wars.
Yeah, no more curve wars, exactly. Yeah, no more convex, concave or whatever. Yeah. But I think it's interesting because if you think about it, prior to the pandemic, you see Bitcoin and other digital assets to show low correlation to traditional financial market instruments, and in itself, crypto has basically behaved as a very different ecosystem in that sense. But over the last 2 years, as Bitcoin has seen wider mainstream adoption, its correlation with macro assets has picked up. So it's an unfortunate thing as well, or fortunate, whatever you think about. Yeah.
Logical.
Yeah, it's logical. Of
It
course.
is logical.
So
Yeah.
in particular, you see Bitcoin appears positively correlated with proxies for inflation risk. So you see like your break-even inflation, your crude oils, your big tech and what's not. Bitcoin is very correlated with them right now, positively correlated. And it's natural that you see, how the central bank monetary tightening across the world has put them in this precarious position, right? So no longer immune to macroeconomic forces as well. Yep. That's the big reason why you start seeing great dip, right? The big dip. Yeah. Yeah. The sell off.
Yeah, you can't just buy the dip anymore, man. That used to work so well. It's like dip 10%, buy, it goes up 15% next day, sell. So you just keep repeating. That just doesn't exist.
It's no longer the case anymore. Yeah.
The dip keeps dipping. So sad.
Yeah, and I think one question for me, and I'm sure the listeners out there is, and this is a tough one, right? When is it going to bottom out? When do we think, what is our play here, right? For those that are looking to invest in crypto or have already crypto, what's our play, right? What should we do? Should we also kalang kabut and then just sell? Kanchong?
Yeah, I think. Okay, I don't know, right? I think that this is difficult. I think the very valid point is that now crypto is so positively correlated with your big tech equity, right? And so because of that, when you look at it in terms of from the entire portfolio, right, that you have to take that into account, right? It's not a hedge. I mean, I would say it never really was a hedge, but fine, right? Now at least it's not a hedge. Then you think about it, it's positively correlated. What does it do? It has greater volatility, right? So it's really just shifting out your risk curve a bit. But you are going further out and out on the risk curve. You are taking on more risk for more volatility in that sense, even though it's an imperfect measure. And you say, yeah, fine, right? If the sentiments turn around, I will win bigger in, crypto than I will in Nasdaq 100. Right? That's essentially it. If it doesn't turn around, I will lose bigger in crypto than I will lose in Nasdaq 500. So again, personally, based on your portfolio construction, you can then look at, then do I want that risk and therefore I allocate more to crypto, or is all my hard-earned money, so hard-earned and I paid for it in sweat, blood and tears, and I'm not losing any of it, so I'm not touching crypto. Right? I think it's kind of that sense of things. I mean, we can talk about whether it's a Ponzi, spread, like fraud, scam, whatever. But I think as of now, it's quite definitely a legitimate asset class already.
Yeah, I agree. Yeah, so for myself, I think that these dips are good for the space in the long run, because it's simply not feasible or healthy for this space to basically be set up as say easy 100 times X, right?
It's up only, bro.
Exactly. So if it's so easy for everyone to make money, then no one will make money.
Hey, look at this guy pulling out the economics. What is it? Zero-sum game, right?
Yeah, zero-sum game, exactly. Yeah. So sadly, as much as it sucks, some people must be flushed out for others to earn in that sense. I think for me, I don't really have like a playbook on crypto for now, but I think that things like GameFi is a little bit iffy right now, a little bit scary. And when you start looking at DeFi as well, you start seeing like Wonderland turning into like a Ponzi scheme or what's not, whatever you call it.
I think they'll return money.
Yeah, exactly. So it only happened on the back of the big dip in the crypto space. If not, none of this will happen. Like what you say, Anthony, right? The only way is up in that sense. But you need to have some form of creative destruction, some form of macro intervention to come in to make the whole crypto asset a little bit more robust. And I think we should all take a step back and appreciate how far we have come in the past 2 years, trying to come up with decentralized finance as well.